Good morning. It's Jeffrey Christian of CPM Group. It's about 9:55 in the morning on Friday, the 20th of September here in New York. Gold is trading at $2,642.50 right now, record highs this week. Silver is trading at $31.72 at present, which is strong for silver. It's up about 30 cents on the day. Both metal prices have risen somewhat. I want to talk about gold and silver and what the new era of declining interest rates mean for gold and silver. Now, in order to do that, I think you really first have to talk about what we're really looking at in terms of interest rates. And then you have to think about what it means for the broader economy and financial markets. And then you can also talk about gold, what it means for gold and silver. I'll also talk a little bit about platinum and palladium markets at the end of this presentation. This is the upper limit of the federal funds target range. The FOMC targets these interest rates, and they announced a 50.5% reduction in the FOMC meeting at the which ended on Wednesday. That's the first decline since 2000. You can see that we had the zero interest rate policy, 0 to 25% for a long period of time into 2015. Interest rates they started to increase interest rates in 2015. There were liquidity issues and they started to reduce it. Then we got into COVID pandemic and the economic lockdown. They went back to 25 basis points. After we came out of the lockdown in 2021, you saw a lot of inflationary pressures starting to emerge. Inflation got up to about 9%, not hyperinflation, not the 14% that we saw in 1979, 1980, but 9% was very high in the period from 1983 to 2021. 9% was probably the highest rate, having come down from 14% in 1980. The Fed raised interest rates from 25 basis points to 5.5%. They stopped raising rates in the middle of 2023 and plateaued. And then this week they announced a 50% or 50 basis point or 0.5% decline in the Fed funds rate. I use this chart because that's what the Fed targets. And if you actually look at the Fed funds rate, as of yesterday, the Fed funds rate had not declined. It will, but it hasn't yet. So you can see here now. Now, there were people in the gold market and in the broader financial markets who always are purveyors of doom and gloom. And they've been wrong most of their careers. Sometimes we get into recessions and they say, see, we were right, but then we get into a recovery and we haven't seen the end of the modern financial era the way they had predicted. But that doesn't matter to them. They keep believing that any period of weakness is going to be the catastrophic conclusion of 500 years of modern economic activity. CPM Group's view is that you can take interest rate patterns, and this is the Fed funds rate, but you can look at Treasury notes or Treasury bills and see the same sort of pattern. And from the late 1960s into around 2000, you had interest rates most of the time between, say, 5 and 10%. Sometimes things got bad and they went up as high as 21%, which helped kill that 14% inflation in 1980. But most of the time, interest rates were in that really actually closer to 3.5 to 10% range. And that was the post-war stable period. Starting around 2000, we saw interest rates fall below that level. There were a lot of economic changes and there were a lot of financial market deregulations around the world that contributed to an era of lower rates. When we got into the Great Recession and the global financial crisis, you saw interest rates go down to effectively zero. And in some countries, they actually went into negative nominal interest rate periods. And we had this long period of time from, say, 2008, 2009 into 2015 when we had 25 basis points, zero interest rate policies. CPM Group's view was that that was the second era of modern interest rate policies and levels. And then when we started to see interest rates rising in 2022, we said, we think we're moving into a third era of modern interest rates. A lot of people talked about how the increase in interest rates at that time, which ultimately peaked at 5.5% in 2023, was a normalization of interest rates, a return to the pre-2000, 2008 era of 3 to 5 as the low end and 10% as the high end of short-term interest rates. We were saying we're not moving back to that pre-2000 era. We're moving into a new era where how interest rates are determined, how interest rates behave, how interest rates affect the overall economy, as well as financial markets, and what levels are likely to be seen change. Now, reality is CPM Group thinks that on the long run, short-term interest rates probably will range between, say, 3% and 7% over the next many years. That's similar in some ways to what we saw prior to 2000, but the factors behind interest rates have changed dramatically and are not going back to what we saw in terms of the global economy and the U.S. economy 1968 to 2000. So we think we're moving into a third era. It's not doom and gloom. We don't expect to see zero interest rate policies again, except when we get into severe recessions or other economic crises. But we think that you are moving into a third era of interest rates. It's not the end of the world as we know it. It's something different. And the Fed and other monetary authorities and economists have said the same thing. That we're moving into uncharted territories, not only in terms of interest rates and interest rate policies, but also in terms of economic activity. And that makes monetary authorities' jobs that much more difficult. And it probably increases financial market volatility because there are some people who understand that we're in new territory and they don't have guidelines. And then there are other people who hark back to those old times and they get it wrong. We saw an inverted yield curve for the last several years, and people kept saying, well, between World War II and 2008, an inverted yield curve always was presaged a recession. Now, that wasn't true. And in fact, the relationship between an inverted yield curve and a recession was that an inverted yield curve either predated a recession by 2 years or so, or occurred during a recession, or occurred 2 years after the recession. So it wasn't a good relationship before 2008. But they always stopped at 2008, which was very important because the interest rate market and its effect on the economy and the economy's effect on interest rates completely changed with the global financial crisis and the Great Recession. And if you're looking at historical precedents as indicators of future trends, and you don't realize that the market and the economy and the interest rate market has changed, you're going to get it all wrong. Sometimes those history things are important, and we're working on silver right now on a silver report that points out that it's very important to look at the historic patterns of supply, demand, investment demand, fabrication demand with silver prices, because those fundamentals still apply. But the interest rate market has changed dramatically, and it's changing dramatically again. And it's moving into uncharted territories, which complicates policy decisions and investment decisions. CPM Group always talks about, well, what does the lower interest rates mean for the economy, for markets, and for metals? And we always say, A, there's a great misunderstanding about the relationship between interest rates and gold and silver prices. And B, what matters more than the actual levels and directions of interest rates is why are they changing? Why are interest rates declining now is the question of the moment. And it's a very important question. And then the second big question is, how are financial markets reacting to interest rate changes and interpreting them? Why the decrease? Why the decline? The Fed says, hey, the economy is very good, but we're seeing a slight uptick at very low levels in unemployment. We're seeing a maturing economy, and we're seeing inflation coming down. It's not 9% anymore. It's about 3.2%. It's headed in the right direction. So it's time to lower interest rates. We think the Fed is being perhaps a little understated in their concerns about the longer term economic prospects. And we think that, the fact that they are declining, the interest rates are declining, and interest rates are declining initially by 50 basis points. And the fact is that the Fed, if you look at their projections as to where they think interest rates will be a year from now, or 15 months from now, at the end of 2025, the average of the FOMC members' expectations is 3.25% to 3.5%. So they're looking at a significant decline in interest rates over the next 15 months. They're not looking for zero interest rates. They're not looking for this panic decline in interest rates the way the gold and silver promoters are talking. They're looking at a significant decline down to about 3.5%, 3.25%. That's a significant decline, and that signals to us that the Fed really does think that we are in the late stages of a maturing economic expansion, and that there are recessionary pressures and deflationary and disinflationary pressures that are starting to emerge in the U.S. and global economies, and it's time for lower interest rates. Now, the reason interest rates are declining is that the Fed and other monetary authorities are saying we need to ease up on our relative restrictions in monetary policies. And we're looking at the underlying real economy, supply and demand for goods and services, and we're looking at reductions in fiscal stimuli. The federal budget deficit in 2020 was $3.7 trillion. It was $2.7 trillion in 2021. It's only about $1.4 trillion now. Now, that's an obscene deficit, but it's less than half of what it was in 2020. And the Fed looks at all of this and they say, okay, there's less government spending, there's less fiscal stimulus, you're seeing a maturing in demand, you're seeing peaking out in increases in supply. If you look at the housing market, I say why mortgage rates fell, because the Fed monitors and manages short-term rates and mortgage rates or long-term rates. Fed's looking at the economy and saying we need to ease up. And so the decline is the Fed taking steps to preclude or ameliorate economic weakness. And that's very important to understand. It's not that they're reducing interest rates because they think that we're on the precipice of a sharp decline economically. It's because they want to try to live up to their mandate to maximize employment and keep inflation at a modest, tolerable, in their view, level. So that's very important to understand, and that puts into context what we should expect in terms of future interest rates. And I'll point this out too. The Fed and other monetary authorities have been very transparent and honest in talking about what they see in the economy and what they think they're going to do in terms of interest rate policies and in terms of their reserve management. The markets have often refused to listen to or believe or say that they're believing what the Fed is doing. The Fed is signaling what they expect to happen over the next 15 months, and it behooves market participants, including investors, to pay attention to them because they've basically been telling us what they're going to do. They're not talking about going to zero interest rates imminently. They say they can do that in the future if it's needed, but their expectation is that they will be reducing interest rates to the low end of that normative range, that 3 to 7% that we expect, or the 3 to 10% that we saw prior to 2000. Now, that's the reality. Then you have to worry about how the financial markets react to it and interpret it. And that's where mortgage rates come in. We saw a sharp decline in mortgage rates yesterday, the average mortgage rate, but you have to put that into context. And I won't bore you with a lot of housing market details because I want to move on to gold and silver. But mortgage rates have been declining for several weeks, if not months already. And you're seeing increased supply of unsold houses, increased production of unsold houses. You've seen not only mortgage rates decline, but also the average and median prices of new house sales declining too. So, and you're seeing a sharp reduction in mortgage delinquencies. So the housing market is showing some weakness in terms of new sales and maturity and stability in terms of existing mortgages. And the fact that mortgage rates fell the day after the FOMC said it was reducing short-term rates, partly, yes, that's a reflection of the market's expectation and mortgage bankers' expectations of future interest rates. But it's also important to put it into the context of the fact that the housing market has seen lower interest mortgage rates for several months now already. Let's turn to gold and its relationship with real and nominal interest rates. And it's very important to understand that it's a very complex relationship. This chart is kind of busy. The red line are inflation-adjusted interest rates, and you can see they haven't been negative. They haven't just been negative for the last 2-3 years. They've been negative pretty much since 2008, inflation-adjusted interest rates. And in that kind of environment, zero interest rates on a nominal level, negative interest rates adjusted for inflation, gold prices have risen. It's not the only factor that's been driving gold prices higher, but it's a very important factor, both directly in terms of the relationship that investors have, saying, what can I earn on treasury bills in the case of this chart? Oh, I'll lose money year in, year out if I had my money in short-term interest rates. Therefore, gold has a very low opportunity cost to be investing in gold. The direct relationship between interest rate levels and gold. But then there's this indirect relationship in that interest rates determine overall economic activity and stock market performance and bond market performance. So there's an indirect effect on gold. And as a result, the relationship's much more complex. This is a scatter plot of changes in real interest rates and changes in gold prices. You can see up at the top, right left-hand corner, January 1980 and June 1980. The correlation is 16%, negative 16%. There are a lot of people say, well, higher interest rates mean lower gold prices, lower interest rates mean higher gold prices. That's not necessarily the case. It is the case, 16% of the time. But you can see there are all kinds of periods. This is all monthly data. Since, I guess, since 1980, maybe before that. There are periods of time when interest rates and gold prices are rising. There are times when they're both falling, times when one's rising, the other's falling. It depends on why interest rates are rising or falling, what the effect is on the gold market. So it's not a simple correlation. You can't simply say oh, the Fed is now lowering interest rates are going to fall, ergo, gold prices are going to rise. We think gold prices are going to rise, but for a variety of factors, just one of which is lower interest rates. If you take that plot and you say, okay, well, when is it that interest rates are rising, but gold prices are falling? That's this lower quadrant. What is the interest rate environment there? And what you find is that's when you have real interest rates of 3% or higher. Now, if you have real interest rates, if you have inflation of 3.2% and you have nominal interest rates now at 5%, that means you have a real interest rate of 1.5%, roughly speaking, 1.7%. If you look at the historic relationship between real interest rate levels and gold prices, it takes more than a 3% real interest rate, inflation-adjusted interest rate, for investors to say, why would I invest in gold? I can earn 3% or more on an inflation-adjusted basis in short-term interest rates, treasuries, okay? 3%, we have 3.2%, that's 6.2% interest. We got up to 5.5% last year. We were at 5.5% for roughly a year. And now we're coming off in terms of nominal rates. We did not get to 6.2%. And quite frankly, when we were at 5.5% a year ago, inflation was probably closer to 3.8 or 4%, not 3.2%. So the view is that interest rates can be negative when they're much higher than we have seen and then we expect to see over the next 2 or 3 years. That's really the key to understanding the relationship right now between interest rates and gold. Gold prices have risen. We're at record levels. We've seen new highs over the last few days. It's not just interest rates. It's domestic politics. It's international politics. It's overall economic expectations. It's increased volatility in the stock market and the corporate bond market. It's a lot of factors. It's not a collapsing dollar, by the way. The dollar is actually holding up very well. But it's not just interest rates. Our expectation is that we're going to see higher gold prices over the next several months, couple quarters at least, 2 or 3 quarters. And it's probably going to be mostly for non-interest bearing factors. The U.S. economy, international politics, U.S. politics, domestic politics in other countries around the world. I think all of those factors will help push gold prices to new record highs over the next 2 or 3 quarters. Interest rates and declining interest rates will be one of the factors involved. Silver prices have risen. They're lagging gold, much to the dismay of silver true believers. It's not surprising. Coin dealers around the world, as well as silver bullion dealers in other parts of the world, report that there are a lot of investors who had bought silver several years ago at higher prices are now taking the advantage of silver over $30 to sell. So a lot of coin dealers in North America as well as in Europe and other parts of the world report heavy resales from investors, and some of them are reportedly not even willing to buy silver when investors come in, which is a very worrisome trend because investors count on those coin dealers to make a two-way market. We want to talk a little bit about platinum and palladium. Platinum prices have risen over the last few weeks. They've gotten up over $1,000. They've come back off. CPM Group thinks that platinum prices could come off further over the next several weeks. Probably not next week because October is an active delivery month for platinum, and we think that will help keep the price up. But over the next 2 or 3 weeks, we wouldn't be surprised to see the platinum price move lower. Again, we have been telling investors for some time that we don't think of platinum as an attractive long-term investment. We saw this sharp decline from 2013, 2012, 2013, 2014, 2016. We've moved sideways since that time. We do think that platinum prices will rise from time to time, and investors who want to play on short-term investments can find times when it makes sense. But right now, we don't necessarily see platinum as an interesting market. We saw a sharp increase in palladium prices over the last couple weeks, and now the price is coming back off. What you saw was speculative buying. Vladimir Putin said something about limiting nickel, titanium, and uranium exports to countries that are imposing embargoes and participating in embargoes. Well, a lot of those countries have stopped buying the nickel anyway. Russia had stopped selling uranium to those countries years ago, and the titanium sales are relatively small. But when he said that, there were any number of traders and investors who said, oh, they might include platinum, palladium, and rhodium. And they went into the very illiquid palladium market and bought. And they drove the palladium price from around $900 up to over $1,100. The price is starting to come off because people realize, unlike nickel, uranium, and titanium, palladium export earnings are critical to the Russian economy right now. The Russian economy is starved for foreign exchange to pay for imports, and those palladium exports are one of the major sources of foreign exchange. So Russia won't limit palladium exports, and Europe, the United States, Japan, South Korea will not put import restrictions on Russian platinum group metals because they need those metals to make the cars that are so critical to each of their economies. So palladium is off the table as an export ban or an import ban, but that doesn't stop speculative buying when you hear a news event. Then the news event gets digested, analyzed, and then the price comes off, and that's what we're seeing now. That's all I have for now. We'll be back with you next week. In the meantime, take care of yourself, take care of people around you, do something good for the world, and have a good weekend.